Okay, so um, you are welcome to another episode of my series on managerial economics. And in this section, I'm going to introduce you to the various market structures that we have, and then its implications for managerial decision making. Now, so far, we've been able to go through demand and supply, which shows us that market prices are usually determined by the forces of demand and supply. Then after that, we're able to go through issues of consumer behavior. So managers, although we can't control consumer behavior, we need to understand how consumers behave so that we can model our firm alongside. Then afterwards, we came to a very important concept where I mentioned that one of the things that firms have control over is their output and then their cost. Because once you produce and you use inputs, definitely the input will come with certain cost. All right. So firms need to know the optimal combination of inputs that will help them produce the highest output yet at a minimal cost. And that was the idea behind the theory of production and cost. Now, putting all these three things together, managers should be able to price their products, because if you know how the market works in terms of demand and supply, and if you know or you're able to understand the mind of the consumer through utility, and you're able to control or you're able to understand the nature of your cost and the nature of your output, definitely in a way we should be able to price our products. That's notwithstanding, even though manager may know all these three things that I've talked about, what is much more important is the environment that the firm and the consumers operate in. All right. So in this lecture, I'm going to explain to you about four forms of market environment that exist. Okay. And that is the idea behind market structures. Now, there are several form of market structures, but in this section, I'm going to introduce you to four types of market structures. So we'll be talking about the perfect competitive market. We'll be talking about monopoly. We'll be talking about the monopolistic competition. And then finally, we will talk about the duopoly or oligopoly. All right. So the last section will be on the oligopoly market. Okay. But in this particular slides, we will deal with perfect competition, monopolies, and then monopolistic competition. Now, as I said, one of the important decisions that managers have to make is how to price their product, because every firm wants to maximize profit as much as they want to. So even though managers will understand the dynamics of demand and supply, even though they will understand the dynamics of consumer behavior, we need to also understand how the market works, and then the economic environment in which the firm operates and in which the consumers buy their goods. And this is very important because the nature or the economic environment in which the market operates in can affect even the determination of prices. Okay. And even the nature or the economic environment that the firm operates in can even affect the output that the firm brings to the market. And since output is primarily determined by demand and supply, that means, since prices are determined by demand and supply, what it means is that if the firm alters its output, it can affect prices. So in essence, all that I'm saying is that the economic environment in which demand and supply interact can even affect the determination of prices. Okay, so the economic environment here, we are referring to the market structure. So in essence, market structure refers to the economic environment within which buyers and sellers interact. The economic environment within which buyers and sellers interact. And think about it. There are several forms of market structures. For instance, if we look at the sale of sachet water, okay, holding all other factors constant, no single supplier or no single seller can increase the price, because if you all know that the price is, let's say, 20 pesos per sachet water, what it means is that if you sell yours for 40 pesos, holding all other factors constant, nobody is going to buy. Okay. But let's look at an industry like the industry that supply electricity or utilities, to say. Now, the industry in Ghana that supplies electricity or that are in charge of sale of electricity is the Electricity Company of Ghana. Now, once they increase their price, although the demand will get a little affected, still people are going to buy from them. Okay. So this simply means that the nature of the market or the economic environment in which the market in can even influence the power or the extent to which firm can alter their prices. Okay, and that is what we are talking about when we refer to market structures. Now, how do we distinguish one form of market structure from the other? How do we distinguish one form of market structure from the other? Now, one of the pillars that we can use to distinguish one market structure from the other is the number and size distribution of sellers. Number and size distribution of sellers. Now, here, usually in a market where there are so many sellers in the market, what it means is that each seller will sell just a small portion of the output. Okay. So that means that in a market where there are large number of sellers, if there are large number of sellers, what it will mean is that each seller is going to sell a small fraction of the market output. Just think about it. Now look at the number of people who sell sachet water in Ghana. They are so much. That means that a single firm alone is able to produce and sell a small proportion of the entire market output. Okay. That means that in a market where there are large number of sellers, that means that the size distribution of each seller will be small. So here we are going to contrast, or we are going to look at where there are a large number of sellers, yet each seller sells a small output. And that concept is called large few sellers. Large number of few sellers. Okay, large number of few sellers. So in a market where there are large number of few sellers, what it means is that in such a market, it will be very difficult for a single firm to set the price. So like the market for sachet water, for instance, there are so many sellers and each of them sells a very small proportion of the market output. So even if one firm says that I'm reducing my supply, thinking that prices will rise, it will never happen, because one firm just forms a very minute or a very infinitesimal proportion of the market. Okay, so a single firm cannot influence the price by reducing its supply, because holding demand constant, if you reduce supply, prices will increase. But because a single firm is just a minute proportion of the entire market, when they reduce the supply, the price increase will just be insignificant. It will just be almost equal to the fact that the prices didn't even change at all. All right. On the other hand, if there are a few number of large sellers, what it means is that here, if there are a few number of sellers, but each of them sell in large quantities, in such a market, chances are that the sellers will be able to influence the price. Think about it. Let's say in a market where there are only 2 or 3 sellers of that good, let's say across the country. If one of it, so I'm saying that here we have few number of large sellers. So what it means is that in a market where the sellers are few and they sell in large quantities, what it means that if one of them should reduce their supply to the market, it will have a significant influence on the price. So in a market where there are few number of large sellers, so in that market, the sellers are few and all of them sell in large quantity. In such a market, the sellers will have the ability to influence the price. And also, we can have an extreme form where we don't, where it is not about small number of large sellers, but we can also have a situation where we have only one seller. And when we have only one seller in the market, what it means is that that seller is able to control the price alone, because that seller is the sole producer of the good in the market, and that seller is able to control the price by changing its output. So for instance, if a firm is the only seller in the market, once that firm reduces the supply, it means that the entire market supply will reduce, and this means that holding demand constant, prices are going to rise. So in a situation where we have one seller in the market, we call it a monopoly. That seller is able to monopolize the market and control the market. Okay. So that is one of the ways we can distinguish between market structures. Another way we can distinguish between market structures is the number and size distribution of buyers. Number and size distribution of buyers. So for instance, in a market where we have a large number of few buyers, of course, when the buyers are many, it means that each buyer will be buying just a small proportion of the market output. So in a market where we have large number of few buyers, what it means is that the buyers, one single buyer, it was difficult for the person to influence the price because the person will have a very low bargaining power because there are several buyers. So you alone, you can't influence the market price because your demand is just a small proportion of the entire demand, and you can't influence the market price. On the other hand, if we have a few number of large buyers, for instance, in a market where, let's say, the buyers are very few and all of them buy in large quantities, those buyers likely are able to influence market prices. Those buyers likely will be able to influence market prices. So here, what it means is that in a situation where we have few number of large buyers, that situation is called an oligopsony. So in a market where we have few number of large buyers, that situation is, it will never be a perfect competitive market. It will rather be an oligopsony. And then in a market where we have only one buyer, that market is a monopsony. So a market where we have only one buyer, that market is called a monopsony, and the buyer will be able to influence the price. On the other hand, in a market where we have so many buyers and all of them buy a small proportion, that market is likely to be a perfect competitive market. It will not be a monopsony or an oligopsony. All right. The third characteristics of market structure, or the third thing that we can use to distinguish among the various market structures, is product differentiation. Product differentiation. Now, here, in a market where the products of every firm is so different from each other, it means that every firm can control their price because my product is different from another firm's product in the market. So in essence, product differentiation can be defined as the extent to which the output of one firm in an industry can be distinguished from the output of another firm in the same industry. So that means that in an industry where there is a high degree of product differentiation, what it means is that the output of one firm is so different from the output of the other firm. And that means that each firm will be able to control its price. Okay. Now, in an industry where the firms sell very homogeneous products, in essence, in an industry where there is a very low degree of product differentiation, that means that the product of one firm is not so different from the product of another firm. In such an industry, it is likely to be perfectly competitive because the buyers can buy any of the output of the firm because it is not so different from each other. So in an industry where we have only one seller, that means that there will be 100% product differentiation because he's the only person, and no firm, even no other firm exists to even have a product that we can even compare. Okay. So in an industry where we have only one firm, that means that there will be 100% degree of product differentiation, and that industry is likely to be a monopoly industry. But in an industry where the firms cannot really differentiate their product from another firm, that industry is likely to be perfect competitive. So the degree of product differentiation can also affect or can also tell the nature of the market structure. The next one is the conditions of entry and exit. Now, when entry and exit barriers are high, what it means is that no, it will not be easy for other firms to enter the market. So in an industry where there's a very high degree of or there's a very high entry and exit barrier, in that industry, it's likely that there will be few firms, and those few firms can monopolize the market. Okay. On the other hand, in an industry where there are the entry and exit barriers are so low, that means that everybody can enter and come out at the same time. In such an industry, chances are that it is likely to be perfect competitive because so many firms can enter at the same time and leave at any time. Okay, so in such an industry, it is likely to be perfect competitive. Now, putting all these factors together, it means that always we have monopoly on one hand, and then we have a perfect competitive market on the other hand. Now, if you look at these factors that we've talked about, if we have a single seller, okay, if that seller, his product is so different, and if in that market the entry and exit barriers are high, it means that that seller will be able to influence the prices because he will then monopolize the market. So he will be able to influence the prices, okay? Now, the ability of a firm to influence price by changing its output or by changing its supply, that concept is called the degree of market power. So if you look at all the characteristics I've talked about earlier, you realize that a monopoly firm really has a very high degree of market power because a monopoly firm can easily influence its price by changing the level of output it brings to the market. Okay. Now, there is a measure that we use to measure the degree of market power. So if you remember our markup versus margin, markup and margin, anytime we are adding a certain percentage to our costs to set prices, we call it markup. Okay. Anytime we add a percentage of our cost to our cost to set prices, we call it markup pricing. Okay. That means that if you are a firm and you are able to set your price far above your marginal cost. Okay, somebody will be wondering, why am I talking about marginal cost? I'm talking about marginal cost because in economics, we do marginal analysis. So even in cost, it's best to look at it from the marginal point of view. Okay, so here, if a firm is able to set its price high above its marginal cost, what it means is that the firm will be able to get so much profit. All right. So Lerner deduced this index as a measure of market power. So this index here simply tells the percentage of your price, that is your markup. So price minus marginal cost is actually the markup profit, okay? Divided by price, you get, and if you multiply it by 100, you get a percentage of your price, that is your profit or your markup profit. And it means that if it is very high, if this ratio here is very high, it means that you are able to set your prices far above your marginal cost. You're able to set your prices far above your marginal cost. And this means that you have a very high degree of market power. So this formula here is actually called the Lerner index. The Lerner index, okay? The Lerner index. And it tells the degree of market power of the firm. What it means is that the higher the Lerner index, the higher the market power. The lower the Lerner index, the lower the market power. Now, even though the factors I've talked about earlier has the ability to influence the degree of the market power, what is also much more important is the elasticity of demand of the market, because the degree of your market power can be restricted by the elasticity. The fact that you have a high market power doesn't mean that you can set prices anyhow, okay? And here, let's try and distinguish between a monopoly and then a necessity good. Now, the fact that there's a single firm selling a certain product in a certain industry doesn't make that product a necessity per se. So the fact that a monopoly sells a certain product doesn't make their product a necessity. Think about it. For instance, if in Ghana, ECG is the sole supplier or the sole seller of electricity in Ghana, that doesn't make electricity a necessity, because even in Ghana, not every household uses like electricity from ECG. Some people use solar, some people use windmill, some people use coal, etc., to generate electricity. So the fact that in the electricity industry in Ghana, ECG is the sole supplier does not mean their electricity is a necessity per se, all right? So let's try and understand that concept. So what it means is that even though monopoly has power, the extent to which they can influence their prices is also dependent on the elasticity of demand. So for instance, if a good is very inelastic, okay, if a good is inelastic, what it means is that you could increase your price and then nothing really will happen. But if a good is elastic, a small increase in price will lead to a very big decrease in quantity. So the extent to which monopolies can even exercise their market power can be restricted by the elasticity of demand. So I'm going to show us a proof, a mathematical proof of this. Okay, so here we learned from marginal analysis that the firm maximizes their benefit as where marginal revenue is equal to marginal cost. Now note that total revenue is equal to price times quantity, okay? So marginal revenue, which is the same as the total revenue over the quantity, is equal to, using the product rule, we have P dk plus Q dp dk. All right, we've done this already. So this and this cancel. So marginal revenue will be equal to P plus Q dp dk. All right, this is marginal revenue. So in essence, if marginal revenue is equal to marginal cost, I can now equate P plus Q dp over dk, which is marginal revenue, is equal to marginal cost, okay? So I'm going to send marginal cost to the left-hand side, and I'm going to send the Q dp dk to the right-hand side. So now we will have price minus marginal cost is equal to Q dp over dk, all right? Q dp over dk, negative, of course, because it has crossed the equal to sign. Now, if I divide both sides by price, I'll have price minus marginal cost over price is equal to Q over price and then dp over dk, okay? So this, I divide both sides by price, this is what is going to happen. And let's note that Q over P times dp over dk is an inverse of elasticity. So in essence, price minus marginal cost over price is equal to 1 over elasticity of demand, okay? Because Q over P times dp over dk is an inverse of elasticity of demand, because elasticity of demand is actually dk over dp times P over Q, is the inverse of this, okay? So in essence, market power, price minus marginal cost, is equal to 1 divided by elasticity of demand, all right? Now let's do further analysis now. So establishing that price minus marginal cost over price is equal to 1 over elasticity of demand, that means that here, think about it, mathematically, whenever, so let's look at this whole thing as the market power, okay? Now think about it. I want us to recognize that if the denominator of a fraction increases, it means that the whole fraction will begin to reduce. All right. That means that the more elastic, the more price elastic a commodity is, the lesser the market power. Because if this denominator here begins to increase, the whole fraction, which represents market power, begins to now reduce. All right. And if the elasticity of demand also reduces, what it means is that the entire fraction will now begin to increase, because the denominator of the fraction is decreasing. So the entire fraction will now begin to increase. All right. So if elasticity of demand is decreasing, it means that we are approaching inelastic. And if elasticity of demand is increasing, it means that we are approaching elastic, or we are going to the elastic zone. So in a nutshell, what it means is that if this thing here represents market power, it means that the more elastic a product is, the lesser the market power of the firm. And then the less elastic a product is, the more the market power of the firm. Okay. So here, I could just give an example, and I could give you that price is equal to 20. And now I can say elasticity of demand is equal to 1.40. And I can say find the marginal cost. Find the marginal cost. I can say find the marginal cost. So here, if I want to find the marginal cost, it will simply be price minus marginal cost over price, which is 20, is equal to -1 over the elasticity of demand, that is 1.40. Okay. So here, if you do cross multiplication, we will have 1.40 multiplied by 20 minus MC is equal to -1 multiplied by 20. So we are doing cross multiplication. All right. So 1.40 times 20, we'll get 28 minus 1.40 marginal cost is equal to -20. All right. So we'll group like terms. So 28 plus 20 is equal to 1.40 marginal cost. Okay. So 28 plus 20, that would be 48 is equal to 1.40 marginal cost. If you divide both sides by 1.40, then so if you divide 48 by 1.40, then the marginal cost is going to be 34.29 approximately. All right. So we could give you this element and you can be asked to find the marginal cost. We should note that. Okay. So I've explained to you why, if a good is fairly elastic, the firm will have a low market power. And if the good is fairly inelastic, or if the good is inelastic, the firm will have a very high market power. Okay. So in summary, if you put these characteristics together, that means that perfect competitive market is at the extreme end, or that's on one hand, perfect competitive market is at the extreme end, and then monopoly on the other hand is at another extreme end. Now, as perfect competition approaches monopoly, or as some of the conditions become relaxed, we enter into monopolistic competition. And as some of the conditions become more relaxed, we now enter into oligopoly, and then we will now enter into monopoly. So in this section, we are going to treat perfect competition on one hand and a monopoly on the other hand. Monopolistic competition has more relaxed rules as compared to perfect competition, the nature or the characteristics of perfect competition. And oligopoly too has more relaxed rules as compared to monopolistic competition. And the monopoly also is like that. So the characteristics of perfect competition, those characteristics are lessened a little for us to get to monopolistic competition. And the characteristics of monopolistic competition are also lessened a little to help us get to oligopoly, and on and on and on and on. All right. So for instance, In a firm where there are many buyers and sellers, it is perfect competition. But as the number of buyers and sellers begin to reduce, then we are entering into monopolistic competition. If it reduces further, we can go to oligopoly. And then if it becomes only one seller, then we now enter into monopoly. All right. So perfect competition and monopoly are at the extreme ends. And in between them, we can have monopolistic competition and oligopoly. Now, let's pick perfect competition market. What are the characteristics of a perfect competition market? Now, it is a market that has many buyers and sellers. Number two, they sell very identical products, okay? I mean, the output of one firm cannot really be distinguished from the other, and that makes the market very competitive. Number three, because there are many buyers and sellers, that means that no single seller can influence the price, and it means that they don't have market power to even influence the price. So we say that firms in a perfect competitive market are price takers. Firms in a perfect competitive market, they are price takers. Number four, there is perfect information on both sides of the market. There is perfect information on both sides of the market. Now here, for instance, currently, if you go to some parts of the national capital, that is Greater Accra region, you realize that a bottle of water, even the 0.75 liters, it is sold at 1 cedi, right? The 0.75, yeah, 0.75 liters, the medium size is sold at even 1 cedi. Now think about it. If all the buyers in Ghana knew this information, okay, all the buyers will wish that the bottled water is sold for 1 cedi instead of 1 cedi 50 pesos across Ghana, all right? And it will force the price back to 1 cedi, and then the suppliers cannot do anything about it, or the sellers cannot do anything about it. So in a situation where consumers, they know everything about the price of a product and about the quality of the product, a single firm cannot alter the price. The firm will be a price taker, and the firms in the market will be a perfect competitive firms. So here, whenever there is perfect information in the market, it makes it difficult for the one single firm to control the market. The firm in the market will be a perfect competitive firm. Number four is that there are no transaction costs. So here, we assume that for you to buy from firm A or firm B, there is no traveling cost, okay? So if I want to buy something from, let's say if I want to buy something from town, or I want to buy something from campus, holding the transportation cost constant, the prices in town and campus should technically be the same. All right, that means that a single firm cannot influence the price because of the allocation. So on the assumption that there are no traveling costs, that means that a single firm cannot influence the price because of the allocation, and then they will be price takers. The next one is that firms in a perfect competitive market, or one feature of a perfect competitive market, that there is free entry and free exit, okay? And then, so I think this one I've explained it when I was talking about the characteristics. So usually in a perfect competitive market, there is free entry and free exit. Firms can enter the market anytime they like, and they can leave the market anytime they like. And this makes the market very competitive. Okay, now, definition of a perfect competitive market. Now here, it is defined by their characteristics, okay? So you can just read this definition because it is defined, their definition is just by their, is defined by their characteristics. Now, how do we determine the equilibrium price of a perfect competitive market? Now, note that the entire price of the market is determined by market demand and market supply, okay? The entire price of the market is determined by the entire market demand and the entire market supply, okay? But a single firm in the market cannot change price unless all the firms in the market says that, let's say from next week going, we are going to increase the price, and they can alter the price. But a single firm cannot alter the price. So for the entire market, it will have the normal demand curve. For the entire market, a perfect competitive industry will have a normal demand curve. So it means that if they raise the price, okay, quantity will fall. All right. If they reduce the price, quantity will rise. If they reduce the price, quantity will rise. Okay. So if all the firms in the market say we are increasing the price, quantity will fall. If they decrease the price, quantity can rise. Okay. Now, that is for the entire market. On the other hand, a single firm in the market cannot alter the market price. So when we talk about the demand curve for a single firm in a perfect competitive market, the demand curve is straight. It is perfectly elastic, like this, perfectly elastic. That means that at the same price, you can sell different quantities. At the same price, we can sell different quantities because a single firm cannot alter the price. It means that if a single firm increases the price, nobody will buy. That is why for a single firm in a perfect competitive market, you cannot have a normal demand curve. Your demand curve is perfectly elastic because you alone, when you change your price, nobody would buy your good because there are many buyers and sellers. And obviously the sellers sell homogeneous or similar products, so nobody will buy. So here, the demand curve is perfectly elastic. Now, somebody will be wondering, if we can raise prices in a perfect competitive market, why don't we reduce prices to make more money? Now, it is economically not wise to reduce prices in a perfect competitive market because if you are a firm, if you are a single firm and you reduce your price, it is not economically wise because since the demand curve is perfectly elastic, you can sell different quantities at the same price. So if you want to get more money, rather focus on producing more and selling rather than reducing your price. Because at the same price, you can sell so much, you can sell different quantities that you want. So if you want to make more money, it is economically wise to rather increase your output than to rather reduce your price. So the price always will remain the same at the different levels of what demand or quantity demanded. That is why the demand curve of a single firm in a perfect competitive market is perfectly elastic. Okay. This also means that for a single firm in a perfect competitive market, the marginal revenue is the same as the price. The marginal revenue is the same as the price. So for a single firm in a perfect competitive market, the marginal revenue is the same as its price. Think about it. If we can sell different quantities at the same price, let's say I'm selling 50 units, okay, at 5 cedis, because the price will never change. And I now come and sell 100 units still at the same 5 cedis. So here I'll get 250 cedis. Here I'll get 500 cedis, okay? Marginal revenue is change in total revenue over change in quantity. So the change in total revenue is 500 minus 250. Change in quantity will be 100 minus 50. So here you get 250 over 50, and we still get back to the 5 cedis of price. Even if I sell 500 units, I'll still sell it at 5 cedis, okay? So 500 times 5, you get 2,500 total revenue. So if I still want to find a marginal revenue, the new change will be 2,500 minus 500 over 500 units of quantity minus 100 units of quantity. So here you get 2,000 over 400, and we still get the same 5 cedis. So for a perfect competitive market, a single firm in that market, your marginal revenue is always equal to your price, because no matter how much you sell, you still sell it at the same price. So for such firms, their marginal revenue is equal to their price. And this is something very important when it comes to calculations and perfect competitive market. Their marginal revenue is the same as their price. Let's note that. So for perfect competitive market, their marginal revenue is the same as their price. Because if I sell 50 additional units, I'll still charge the same 5 cedis. And when I find the marginal revenue, I'll still get back to the 5 cedis of price. Okay. So their marginal revenue is equal to their price. Let's note that. Now, how do we establish the profit maximizing point of a perfect competitive firm? Now, let's remember, we did this earlier. So let's remember that when we have a curve like this, of course, cost is always U-shaped. And I've explained that in theory of production and cost. So this is total cost and this is total revenue. Now at point A, the firm breaks even. At point B also, the firm breaks even. Okay. Now, what this means is that at point A, the firm can still produce because when the firm exceeds point A, total revenue curve exceeds the total cost curve. So all this portion here is profit. Now, at point B, when the firm exceeds point B, what is happening is that the firm will now be incurring losses because total cost will now exceed total revenue. Okay, so when should the firm or which point does the firm maximize profit? Now at point A, it means that because the two curves are meeting, the slope of the total revenue should be equal to the slope of the total cost at point A. Now, the slope of the total revenue is simply change in y over what? Change in x. So the y-axis is total revenue. So it is change in total revenue over change in what? Quantity. And this is marginal revenue. So keep in your mind that the slope of the total revenue curve is the marginal revenue. All right. Then let's look at the slope of the total cost. That one too will be change in y over change in x. And that is change in total cost over change in quantity, and this was marginal cost. So always keep in your mind that the slope of the total cost is the marginal cost. Okay. Now we are saying that when the firm maximizes profit, the slope of the total revenue must be equal to the slope of the total cost. That means that marginal revenue should be equal to marginal cost, but the marginal cost will be what? Rising. Okay. So at profit maximizing point of a perfect competitive firm or of any firm at all, their marginal revenue should be equal to their marginal cost, but their marginal cost will be rising. Okay. Now, since marginal revenue is the same as the price for a perfect competitive firm, what it means is that for a perfect competitive firm, the profit maximizing point is when their price is equal to their marginal cost. So it means that the marginal revenue can be replaced by the price. So it is when price is equal to marginal cost. Okay, when price is equal to marginal cost. That is the profit maximizing point of a perfect competitive firm. Okay, let's look at an example. So this example says that price is equal to $10 and total cost is 5 plus K squared. And we've said that at profit maximization for a perfect competitive firm, the price should be equal to what? Marginal cost. Now, marginal cost is equal to change in total cost over change in quantity. That is the TC over the KO. So if you differentiate this function here, we will now have 2K. So the marginal cost is equal to 2K. Marginal cost is equal to 2K. All right. Now, here, what it means is that if you want to find a profit maximizing quantity, we will use this condition. Price is equal to marginal cost. So 10, which is price, should be equal to marginal cost of 2K. So that means K will be equal to 10 over 2, and then K will be equal to 5. So the number of units that maximizes profit is 5 units. The number of units that maximizes profit is 5 units. Okay. The number of units that maximizes profit is 5 units. Now, if you want to check maximum profit is found by simply putting in the number of units that maximize profit into the profit function. So profit is simply total revenue minus total cost, okay? But total revenue is what? Price times quantity. That will give us the price, which is 10, times the quantity, which is 5. That will be what? 50 cedis, all right? Then total cost function is 5 plus KO squared. That means that we have 5, and the quantity is 5. So 5 plus 5 squared, and that will be 25 plus 5, which is 30. Okay. That means that the profit will be 50 minus 30, and that will be equal to 20 cedis. So the profit is 20 cedis. The profit is 20 cedis. That's the maximum profit. All right, so we are going to illustrate this concept on a graph, and it's very simple and straightforward. Now, if we draw a graph, so this will definitely be my total revenue, okay? This is my total revenue. And then the price is a straight line. Let's remember, the price is equal to the demand curve, and it's equal to perfectly elastic demand. So the price is 10 cedis, and this is my demand curve. Okay, this is my demand curve. So this is the total revenue curve. This is the demand curve. Now, we are saying that we maximize profit when the price is equal to marginal cost. So I'm going to draw a marginal cost curve. For now, we don't even need the total revenue curve, which is, I mean, we don't need it, but you can put it there if you want. So I'm going to draw a marginal cost curve like this. So the marginal cost curve is like this, okay? And then I'm going to draw an average cost curve, So average cost curve, definitely the marginal cost curve should have passed through the minimum point of the average cost curve. And I've explained this under production and cost. Now we are saying that output that maximizes profit is when price is equal to marginal cost. So this is the price line, and this is the marginal cost line. So the equilibrium point is achieved here, where price is equal to marginal cost. So we've got that output to be 5 units. Remember, we got that output to be 5 units. Okay. Now, if you trace, so here is marginal cost, average cost, and price. All of them are on y-axis. Okay. Now, if you trace this 5 units to the average cost curve, and you trace it to the y-axis, you should get the average cost. Okay. Now, average cost is total cost over quantity. And let's remember that the total cost, if you remember from the slides, if you remember, I think the total cost was 30 cedis. The total cost was 30 cedis. So now we will have 30 over quantity, which is what? 5. So the average cost is 6, okay? So once we put the quantity in the average cost function, we are going to get the average cost. So it means that once we trace the quantity to the average cost curve, we can get the average cost here, which is 6, okay? Now, economists tell us that the profit is this region. The profit is this region. The profit is this region, all right? Let's note that profit is total revenue minus total cost. That is price times quantity minus average cost times quantity, because total cost is average cost times quantity. If we cancel out the quantities, the profit per unit will be price minus average cost. If we take out if we divide both sides by quantity, it means that you get per unit profit. So the per unit profit is price minus average cost, or how much price exceeds the average cost, okay? And based on a certain quantity, all right? So this portion represents how much the price exceeds the average cost as restricted by what? A quantity of 5. So this region represents the profit. Now, in mathematics, if you want to find the area of a rectangle, the area of a rectangle is simply the length times the breadth. The area of a rectangle is simply the length times the breadth. Now here, the length is from this portion to this portion. The length is from this portion to this portion, okay? What it means is that the length is 5. And then the breadth is from 6 to 10. This portion is the breadth. This place is the breadth. So the difference between 6 and 10 is what? 4. So when you multiply, you get 20 cedis profit, like what we got in the slice. In the slice as well, the profit was also 20 cedis. Let's remember the profit was 20 cedis here. So I could ask you to illustrate this concept on a graph. Okay, I could ask you to do that. Okay. Now, this is the illustration of profit under a perfect competitive market. Okay, and I've done that using the example, so you can just read this for your own consumption. Okay. Now, if you want to maximize profit, it's very good in terms of, perfect competitive market. On the other hand, management must also think about losses. Okay, management must also think about losses. Now, even if we are not making huge profit at all, we should be able to minimize our losses. Okay, we should be able to minimize our losses. So let's look at this phenomenon in the short run. Let's look at this phenomenon in the short run. Now, in the short run, it is often said that at least one factor of production is fixed. So in the short run, we have what we call fixed cost and variable cost, because at least one factor of production in the short run is fixed. So always in the short run, we will have fixed cost and we will have variable cost. We will have fixed cost in the short run. We will have variable cost also in the short run. Now, I want to explain a certain concept to us here. Now, for management decision making, it's always important to distinguish between fixed cost and variable cost when it comes to profit determination. So we can have our sales, which is price times quantity. We can have our variable cost, or we can have our total cost, which can be segregated into variable cost, which is the variable cost per unit times the quantity. You get variable cost because variable cost varies with output. Then we can now subtract fixed cost. We can now subtract fixed cost. So this term here is called contribution. Sales minus variable cost is called contribution. And it's called contribution because it's a contribution for us to cover our fixed cost. Okay, just think about it. If we set up a firm and I build my business premises costing 5 million Ghana cedis, okay, and I operate for the first year,
don't expect that in the first year I'll be able to cover the 1 million Ghana cedis of the building because it's a fixed cost. I can't cover it. Now, what I should be concerned about is that if I put the cost of the building aside, I should be able to make profit. That means that any cost I incur that varies with output, that is a variable cost, it must be lesser than the sales I make, and I'll be making profit. So here, in essence, whenever we are making short-run decisions, fixed costs are irrelevant to our decision making. Because fixed costs, whether you produce or you don't produce, you have incurred it. So the thing that varies with output, that is a variable cost, must be much more important when we are doing short-run analysis. Variable cost must be much more important when we are doing short-run analysis, okay? So we have to always segregate fixed cost from the variable cost in determining profit. So what I'm saying is that whenever we have a positive contribution and we even have a loss, it is not bad. So let's say we make 500 cedis of sales. Our variable cost was 200. So it means that our contribution will be 300. And the fixed cost is 1,000 cedis. That means that our profit will be negative 700. For this one, it is not bad because, I mean, this situation is not bad for the firm because fixed cost, you have incurred it and it is irrelevant for decision making. What is important for decision making is the variable cost of 300. So the firm should continue to produce when they are making positive contribution. Now, it is always good to make per unit analysis in economics. So these things we are doing total analysis. So we need to do per unit analysis. Now, if I divide sales by quantity and if I divide variable cost by quantity, the sales will now turn into price. And then the variable cost will now turn into variable cost per unit, okay? So all that I'm saying is that if you want to produce in your short run, make sure your price is bigger than your variable cost per unit. Variable cost per unit simply means average variable cost, average. Variable cost per unit simply means average variable cost. So if you want to produce in the short run, make sure that your price is bigger than your average variable cost. So if we illustrate this on a diagram like this, if we illustrate this on a diagram, here, the price is bigger than the average variable cost. So we need to still produce. It is not bad. Our marginal cost will come definitely. That means that the equilibrium price is above the average variable cost. So it's not bad to produce. Now, let's look at another scenario. Here, if the average variable cost is bigger than your price, it's not good. You have to shut down. Okay. Here, if the average variable cost is higher than your price, you have to shut down. Another scenario here is that when the two of them are equal, it becomes like this. That means that the price is not more than the average variable cost. It becomes like this. Now, what it means is that at the door where the firm can decide to continue production or to shut down is where the price is equal to the minimum, because here is the minimum, where the price is equal to the minimum of the average variable cost. So this is the shutdown point. What it means is that if the price is greater than the minimum of the average variable cost, don't shut down. And if the price is less than the minimum of the average variable cost, you have to what? Shut down. So here we don't shut down. And here we have to shut down. And in between is the decision to shut down or not. So here, this portion is called the shutdown point. And the quantity here is called the shutdown point quantity. Okay. All right. So let's go back to our slides. So looking at this slides here, looking at this particular slide, we have the average variable cost curve here, and the price is more than the average variable cost curve. So here, the firm should sustain short-run losses because the short-run losses are coming from the fixed cost, okay? But then the price is bigger than the average variable cost. So the firm should sustain short-run losses, and the firm should not shut down because this portion of a loss is actually coming from the fixed cost. But the price is bigger than the variable cost, okay? So the firm should sustain the losses because the firm is getting positive contribution. So the firm should sustain the short-run losses, hoping that in future, the contribution will be able to cover the fixed cost. So here the firm should not shut down. Okay, now let's look at this example. In this example, the price is, in this example, the price is lesser than the minimum of the average variable cost. The price is lesser. So here, the firm has to shut down because the price is lesser than the minimum of the average variable cost. The firm would have to shut down. Okay. So let's look at this example. In a perfect competitive, a perfect competitive firm faces the following total cost function. Okay. It's supposed to be total variable cost function. Total variable cost function. Okay. Now, we are saying that the point where we shut down, the price must be equal to the minimum of the average variable cost. Okay. That means that we have to first of all find the average variable cost. We have to first of all find the average variable cost before we can even find its minimum. The total variable cost is equal to 100 plus 150 kilo minus 20 kilo squared plus kilo Q, all right? Okay. So let's find the average variable cost first before we can even find the minimum of the average variable cost. So total variable cost is equal to, sorry. I think, it's still total cost, right? Sorry, because we have fixed cost. So it is still total cost. So here it's supposed to be total cost, not total variable cost. Total cost. Okay. So the total cost function is equal to 100 plus 150 kilo minus 20 kilo squared plus kilo cube. Okay. We all know that this element is the fixed cost because it doesn't vary with output. That means that the total variable cost is the other part, which is 150 kilo minus 20 kilo squared plus kilo cube. All right. Now it means that the average variable cost will be the total variable cost divided by quantity. So you have 150 kilo minus 20 kilo squared plus kilo cube. So all these things divided by kilo, the average variable cost will be 150 minus 20 kilo plus kilo squared because kilo will remove all the one of the kilos from this. So you get this to be the average variable cost. But we are looking for the minimum or the turning point. The minimum or the turning point of the average variable cost. Because if you draw the average variable cost, the minimum is the turning point. Now, we learned in quantitative methods that if you want to find the turning point of a curve, the turning point is that you have to differentiate the curve and equate it to 0. Okay. So if you want to find a turning point of the average variable cost, it will be the average variable cost over the kilo, and we are going to get minus 20 plus 2 kilo is equal to 0. Because if we differentiate average variable cost, which is 150 minus 20 kilo, plus K squared, you are going to get this. Okay. So if you send a 20 to the other side, you have 2K is equal to 20. That means K is equal to 20 over 2, and K is equal to 10 units. 10 units. K is equal to 10 units. That means that the quantity at the shutdown point is 10 units. Okay. Now we all know that when we put this 10 units into the average variable cost function itself, we will get the minimum average variable cost. Because at the turning point, that's where you have the minimum average variable cost of this curve at the turning point. So once we put the quantity in the average variable cost function, you get the minimum average variable cost. So the minimum average variable cost means that we have to put the quantity in the average variable cost function, because this quantity is the quantity that minimizes the average variable cost. So once you put it in the average variable cost function, it becomes the minimum average variable cost. So you have 150 minus 20 into bracket 10 plus 10 squared. Okay, 150 minus 20 into bracket 10 plus 10 squared. And this will give us 50. So it means that the minimum average variable cost is 50. The minimum average variable cost is 50. Okay. And we are saying that at the shutdown point, the price should be equal to the minimum of the average variable cost. So it means that the price is equal to 50 at the shutdown point. So the price at the shutdown point is equal to 50. That means that below the price of 50, you have to shut down, because the price at the shutdown point is 50. So that is what the question was asking us to do. Below what price should you shut down? So the minimum average variable cost, as we did, was 50. So it means that the price at the shutdown point is 50. That means that below a price of 50 cedis, you have to shut down. Below a price of 50 cedis, you have to shut down. Okay. Now, the next concept is the supply curve of a perfect competitive firm. The supply curve of a perfect competitive firm. Now, we have established that a perfect competitive firm should not operate at a price below the minimum of the average variable cost, because such a firm will make negative contribution. All right. So here, this is my marginal cost. Okay. And then this is my average variable cost. Okay. This is my average variable cost. And this is the quantity. Now, no firm should set prices below this point, the minimum. No firm should set prices below this point, the minimum of the average variable cost. No firm can do that. You have to set prices above the minimum of the average variable cost curve, because that is the shutdown point. Okay. Now it means that if I set prices at P1 and I trace it to the marginal cost, because at equilibrium, price should be equal to marginal cost. Remember that. So if I set a price of P1 and it will hit the marginal cost curve, I'll get quantity Q1. If I set a price of P2 to hit the marginal cost curve, I'll get Q2 here. If I set a price of P3 to hit the marginal cost, because at equilibrium, price is equal to marginal cost. So that means that here, I'll get Q3 here. I'll get Q3 here. So now let's bring the prices and then the quantities to a new diagram. So at price E, the quantity was QE. At P1, the quantity was Q1. At P2, the quantity was Q2. And at P3, the quantity was what? Q3. So if you trace all this equilibrium point, if you draw a line to pass through this equilibrium point, it will turn into what? A supply curve. It will turn into a supply curve. So as you've realized, when we are doing analysis, we just do marginal cost, every variable cost, but we don't bring a supply curve. But we say that this is the demand curve. Normally we say this is the demand curve. So technically in this diagram, the supply curve is the proportion or the portion of marginal cost curve above the minimum of the average variable cost. So the supply curve is the portion of the marginal cost curve above the minimum of the average variable cost curve. That is the supply curve, okay? So in analysis, there is technically a supply curve, which is represented by the portion of the marginal cost curve above the minimum of the average variable cost curve. Okay. Now, another thing I would want us to know is that the market supply curve consists of, or the market supply consists of all the individual supplies put together. The market supply consists of all the individual firm supply put together. The market supply consists of all the individual firm supply put together. Okay. Now, if the price is 12 cedis and a firm sells 1 unit, so 12 and 1, this is the curve, then we can trace the curve and pass through here. Now, if at the same price, several firms are selling, maybe together the entire market, we are selling 300 units. That means that if I trace the curve to pass through here, the curve will be like this. If the entire market, when we add all your supply, are still at 12 cedis, and your total supply is 500, it will meet here, then the curve will be like this. If the total industry supply is, let's say, 700, and still at the price of 12 cedis, at 700, so it means that the more the market supply, or the more the total market supply, the flatter the total supply curve will be. The more the total market supply, the flatter the total supply curve of the market will be. All right. Okay. Let's look at the long run situation. Let's look at the long run situation of a perfect competitive market. Now, because there is free entry and free exit, what happens is that in the long run, so many firms can enter the market. In the long run, so many firms can enter the market in the long run. So once so many firms enter the market because people are making profit, the aggregate supply will increase. The aggregate supply of the market will increase. So let me draw this. Maybe you get it better. So here, we are saying that for perfect competitive market, the entire market has a normal demand curve and it has a normal supply curve. Okay. The entire market, I said it earlier. So this is the equilibrium price, this is the equilibrium quantity. And for a single firm, okay, for a single firm, it has a demand curve to be like this, okay, for a single firm. Okay. Now, if the firm is making profit in the long run, please, in the long run, there is no distinction between fixed cost and variable cost. So in the long run, we have total cost. Now, since we are dealing with price, which is a representative of total revenue per unit, we have to also find average total cost, which is a representation of total cost per unit. Okay. So here, since the price is higher than the average total cost, it means that the total revenue is higher than the total cost, and we are making profit. Now, as firms begin to enter, what happens is that the supply will increase. Now, if the supply increases, it will push the prices down. Once it pushes the price down, now the demand curve here will also look like this. Okay, the demand curve will also look like this. Once it pushes the price down, the demand curve of a single firm will also shift down like this, since the prices have gone down. Okay, now further decrease in supply will lead to further reduction in prices, up to the point where the price will become lower than the average total cost. So at this point, the firm will have to shut down. When P2 happens, the firm will have to shut down when P2 happens, because then the price will be lesser than the minimum of the average total cost, because we are dealing with the long run. In the long run, there is no distinction between fixed cost and variable cost. So we have the average total cost. We don't have average variable cost here. Okay. Now, that means that in the long run, because there's free entry and free exit, once the prices are going below the average total cost, the firm will exit. Okay. So what I'm trying to say is that in the long run, the equilibrium point is achieved when price is equal to the minimum of the average total cost. So the decision to shut down in the long run is when price is equal to the minimum of the average total cost, because once the price goes below the minimum of the average total cost, the firm will have to leave the market. You have to shut down. So this is the long run condition for a perfect competitive firm. In the long run, the shutdown point is where price is equal to the minimum of the average total cost. Okay, the price equal to the minimum of the average total cost. And of course, marginal cost also passes through the minimum of what? The average total cost. Remember that. So in the long run, for a perfect competitive firm, the price is equal to marginal cost and is equal to the minimum of the average total cost. Price is equal to marginal cost and is equal to the minimum of the average total cost. That happens in the long run condition. Okay. So that is what happens in the long run. Price is equal to the minimum of the average total cost, like here. Average total cost is the same as saying average cost. Okay. Let's look at this example. A perfect competitive firm faces the following total cost function in the long run. So the total cost function is 100 minus 2K plus, 100 minus 20K plus 0.01 K squared. Okay. So this is the total cost function that they face in the long run, where Q is quantity. Below what price should the firm shut down? Below what price should the firm shut down? So we are saying that in the long run, price is equal to the minimum of the average total cost, or the average cost, which is the same as the average total cost anyway. Now, that means that we have to first of all find the average total cost before we find its turning point. So average total cost is the total cost divided by quantity. And then the average total, the total cost function itself was 100 minus 20 K plus 0.01 K squared. Okay. This is the total cost function. Divided by quantity, you get the average total cost. So you get 100 over K minus 20, because this and this will cancel, plus 0.01 K, because this K will remove 1 K from here. So this is the average total cost. So average total cost is equal to 100 K negative 1, because the K is divided. So I can rewrite it as this. Minus 20 plus 0.01 kilo. Okay. So this is the average total cost function. Now we want to find the minimum of the average total cost. We want to find the minimum of the average total cost. So let's note that the average total cost function itself is equal to 100 KO negative 1 minus 20 plus 0.01 KO. This is the average total cost. So at the minimum or at the turning point, we all know that we have to differentiate the average total cost and equate it to 0 if you want to find the turning point of a curve. So you now get negative 100 KO raised to the power negative 2. Then the 20 will vanish. Then we now have plus 0.01 is equal to 0, all right? So here we will have 0.01 is equal to 100 KO raised to the power negative 2. Okay. Now, this is the same as saying 0.01 is equal to 1 over 100 KO raised to the power 2, because this thing is an inverse, so we can do 1 over that, all right? So then we will now get, if you do cross multiplication, 100, if you do cross multiplication, 100 is going to multiply, or let's put it this way. Now, this thing here, 1 over 100 is the same as saying 0.01. Okay, 1 over 100 is the same as saying 0.01. Okay. Okay, I think there's an error somewhere. All right, so we now have negative 100 KO raised to the power negative 2 is equal to, plus 0.01 is equal to 0. So this 100 will cross and come to the other side. We now have 0.01 is equal to 100 KO raised to the power negative 2, all right? 100 KO raised to the power negative 2. And it's like saying 0.01 is equal to 1 over 100 KO squared, okay, because of the inverse. So now we now have 0.01 is equal to 1 divided by 100 is also 0.01. So we now have 0.01 KO squared. We can multiply both sides by 100. So if you multiply both sides by 100, I think we are now, so if you multiply both sides by 100, I think we are going to get, okay, I think yeah. Okay, I'm trying to find the best way to do it simply for us to get it. So here, so let's come back here. Let's divide both sides by 100. So 0.01 divided by 100 is equal to Q raised to the power, 100 Q raised to the power negative 2, also divided by 100. This and this goes. So when you divide this, you get 0.0001 is equal to Q raised to the power negative 2. So it means that 0.0001 is equal to 1 over K squared, okay? 1 over K squared. So let's do cross multiplication. So when we do this, we will now have K squared is equal to 1 divided by 0.0001. So we will have K squared to be equal to 10,000. That means that K will be equal to square root of 10,000. That means that K is equal to 100 units. All right. So here, the number of units at the minimum average total cost. The number of units at the minimum average total cost is what? 100. Now, it means that 100 units is the number of units that minimizes average total cost. Okay, the number of units that minimizes average total cost. So once we put it in the average total cost function, we are supposed to get the minimum average total cost. Once we put this in the average total cost function, we are supposed to get the minimum average total cost. So the average total cost function itself is the 100 kilo raised to the power negative 1 minus 20 plus 0.01 kilo. Okay, so we are going to put it in. The average total cost is equal to 100 kilo negative 1 minus 20 plus 0.01 kilo. So when kilo is equal to 100, the average total cost will be 100. Of course, 100 kilo negative 1 is like saying 100 over kilo. Okay, so 100 over 100 minus 20 plus 0.01 into bracket 100. So 1 minus 20 plus, I think 1 minus 20 plus 0.01 times 100, I think 0.01 times 100. Okay, so 1 minus 20 plus 0.01 kilo, right? Okay, so this one plus so 0.01 times the 100, I think I'm going to get 1. 0.01 times the 100, I think you are going to get 1. I don't know if I'm writing the function correct. The average the total cost function, let me just check. Okay, so I was just trying to look at the figures. It looks like the equation I chose, the answers will not make sense. So let's make a slight correction to the question. Let's make 100 plus 20 kilo, okay, not 100 minus 20 kilo. Let's make it 100 plus 20 kilo plus 0.01 kilo squared. Because if we do minus 20 kilo, the answers will not make sense. I chose the function arbitrary, okay. I didn't solve it before, so let's try and change the function. So here will be 100 plus this, so here will be plus. So let's make it plus 20 kilo, not minus, okay. Let's make it plus 20, not minus. Of course, it won't affect the final answer of 100. It won't affect the final answer of 100 units. But it will affect the minimum of the average total cost. So the average total cost will be this plus 20. All right, so here will be plus 20. So plus 1. And this will give us 22. Okay. All right. So if this is the minimum average total cost, which is 22 cedis, and we are saying that price should be equal to the minimum of the average total cost, that means that our price is also 22 cedis. So below a price of 22 cedis in the long run, you will have to shut down. Below a price of 22 cedis in the long run, you have to shut down. Okay. Okay. Now, what are some of the factors that can push firms to even alter their price, even though it's not advisable to alter your price in a perfect competitive market? One of them is the market for perishable goods. Now, for instance, let's assume that one basket of tomato or one small basket of tomato is, let's say it is 20 cedis, and everybody is selling theirs at 20 cedis. Now, what will push you to reduce your price is when the tomatoes begin to get rotten. Okay. So even though in the perfect competitive market, all of us are selling it at 20 cedis, one of the things that can push you to reduce your price is when the tomatoes are getting rotten. When the tomatoes are getting rotten, it can push you to reduce your price. So anytime we are dealing with perishable goods, it is better to reduce your price and clear the goods than to let the price remain the same. And when people don't come, then the goods will perish. So one of the things that can force people to reduce their prices, even though we are talking about market, perfect competitive markets, is when the goods are perishable. Now, on the other hand, if the goods are not perishable, we all know that when we increase prices in a perfect competitive market, nobody will buy. So if you think that maybe next year, the association of sellers are going to increase the price and you want to wait till next year, you can increase your price so that nobody will buy. Then you wait for a better market period and sell it. Okay. So when your goods are strictly non-perishable, you can increase the price and so that nobody will buy because it is perfect competitive market. Then you wait for the next market period. All right. So these are the two factors that can affect or that can make suppliers alter their prices, although it is not advisable to do that in a perfect competitive situation. All right, so this will bring us to the end of perfect competitive market. So in the next section, I'll be treating monopoly. And in the third section, in the next session, I'll be treating monopoly and then monopolistic competition. And then that will be it for the videos.